Hi, I'm Tom Lydon here in San Diego at the Charles Schwab IMPACT Conference here with Chelsea Rodstrom, research analyst at Global X ETFs. Great seeing you, Chelsea.
You too.
So as investors are wrapping up 2019 and looking at what's going on around the world in 2020, what are some things they need to be thinking about?
So a lot of investors, when they're sort of worried about a global growth slowdown in 2019, 2020, are sort of overlooking some opportunities that might actually be presented from that. Countries that might be sort of insulated from some of the broader macro headwinds, whether that's trade tensions or geopolitics. If we look at Europe, for example, which has been a prime example of this slowdown, Europe also has one of the top performing emerging markets in Greece, which has had a really strong economic recovery.
You've got a Greece ETF, right?
Yes, the Grek ticker GREK is our Greece fund.
So it seems like just yesterday, Greece was falling apart. What's going on today?
In Greece, there's been a really strong economic recovery. GDP's back on the rise, tourism's booming, and the financial sector's finally recovering some of its health.
So it just can't all be knickknacks and Santorini. Is there a new government in place? And is there a new feeling of positive momentum in Greece? Because it was kind of down in the dumps for a while.
Certainly. So momentum's been building throughout the year, this year in 2019. In July, there were the New Democracy Party took over for the Syriza Party, which was Alexis Tsipras' party before, and markets ticked back up again. And then in the last month, we actually saw yields on Greek bonds turn negative, which indicates that there's positive investor sentiment around Greece's recovery, and still plenty of runway left for Greece to return to pre-crisis levels.
It's had a huge run off the bottom, hasn't it?
Oh, yes, definitely.
Yeah. So let's talk about China, because you offer a variety of tools to invest in China. What are you seeing over there?
So just like globally, where there are opportunities in different markets, there are opportunities within China, within different sectors. And last December, Global X kind of rounded out its China suite to offer investors access to each of the 12 GICS or 11 GICS sectors plus a large cap fund. Because of trade tensions, there's been sort of, it's become more obvious that sectors are affected differently by geopolitics, by policy, by negotiations that are ongoing with the US. So we've seen typically a wide dispersion in China between sector performance, but even more so this year with policy implementation in China, as well as the negotiations.
And how would you say sectors in China stack up against sectors in the US? Is it similar or different?
So there are definitely different drivers in China because of policy, because of its aging population and unique demographics, but also because of where it is on the development curve. Still lagging behind the US in some ways, but it's very much shifting from an economy that's export-led to one that's driven by consumption. And that's really where we see a lot of the growth in China.
Yeah. So if for example, in certain economic cycles, there's certain sectors that do better. The economic cycle in China might look quite different than we have in the US, so you can actually take that same theory and apply it to the China sectors?
Absolutely. So in the US, since 2012, we've seen the difference between top performing and bottom performing sectors at around 34% in terms of returns. But in China, that's about 55%.
Wow.
So it's much wider in China.
Excellent. Great news, good information. Thank you so much. It's great seeing you.
Thanks for having me.